Hello, Maverick traders. Welcome out to your market roundup for October 25th. Corey here with you. Nice to see all of you. Let's jump into things and talk about what's happening in the markets. There is big time tech earnings this week, and that's certainly market news today. So we had a nice rally today. Darren and I did the weekend trading room when we talked about this ABC style correction. I'll shed a little bit more light on that, but that pointed to further upside, a bit more of a rally, and we're seeing that so far this week. The market's up about 1%, small caps up big, 2.7% on the day. Advancers versus decliners, almost 80% of stocks going up today. And again, improvement in the trend. 34% of stocks now above their 50-period moving average. We're not in a bull market, but certainly the short-term trends are turning a little bit more favorable. And I mentioned large cap tech earnings are coming out. Well, today was the day where we were going to start to really get hit with that news. And although the markets rallied during market hours, Google and Microsoft, the first two big names to report, are trading lower. Google down about 5 or 6, Microsoft down about 2%. It's not catastrophic, but certainly there's such a heavy weight. We've got Apple, Facebook, or Meta, I guess you call it, Amazon. They still report later this week, but the first two of the five, I would call it, have disappointed and are selling off. Now, because those five make up almost 20% of the index, it's going to be hard for the markets to rally without those names if those names are selling off. I don't know how much damage they'll do to this rally, but I would expect that after today's nice bounce, we get an inside candle tomorrow. Kind of a choppy candle, almost doji-like, that sort of thing, and then we'll see where we go from there. So as you look at this chart, here's that ABC style correction. Now here's kind of how I see it. If you have the drop and then the bounce back and then the bigger wave, which is normally the third, and the bounce back, and then the fifth and final wave to a new low, that's kind of the short-term trend. Now I think we're in a corrective phase, which is the first leg up. You pulled back off of that. Everyone said, uh-oh, here we go again. Nope, just kidding, we're rallying. And that's how a correction should be. It should be kind of frustrating for those that were betting on the trend, but those that were betting on the trend, look, this thing got long in the tooth. We had been down about 20%. I mean, think about it. This is the S&P 500, and from about mid-August to early October, just in a month and a half, we'd gone from 430 to 360. Now, that's a huge move when you put it into context. I mean, when you really think about the technical damage, the fundamental damage, the price action, that's a 70-point decline from 430. That's 16%. Going down 16% in a month and a half is huge. We were very stretched to the downside, make no mistake. So for us to have a corrective phase, and for that corrective phase to be sharp and to have a big move, that's what happens in bear markets, right? You whipsaw right back up, and it's steep and it's sharp, but these are characteristics of a bear market. When you have huge rally days, that's not what happens in bull markets. Bull markets are slow and steady and grind to the upside. Huge upside days are more a calling card of being in a bear market and snapping back violently. So that's kind of how I see this. And again, I think tomorrow you have probably some sort of inside day. And then Thursday becomes more important and becomes a little bit more critical. That is when Amazon and Apple report after the bell. And that's really going to dictate whether we start to give back some of these gains or whether we break out to the upside and this thing turns green and will, in the short term, start to look a little bit better. I'm less excited about a potential upside move because even if we break above the 50, do I instantly turn bullish? Well, no. You still have this downward slope. The 20 is still below the 50. It just sets up for a really ugly, choppy market. If we fail here and roll over, that's a very good risk to reward because it's entirely possible that this is towards the top of this correction and that we're going to see significant downside. That ultimately we've been talking about this kind of inverse cup and handle. And it's funny because we talked about it back here that we should correct back up. And I thought it would last a little while. Well, sure enough, it's kind of what's happening. It's just been ugly and volatile. It didn't happen in the way that I expected, in the time period that I expected. But sure enough, it's kind of exactly what's played out in an ugly fashion. So, I'm of the mindset that it's not attractive towards being super bullish here. Is it possible you break out and you just go screaming higher? Yeah, but I don't like playing breakouts that are counter trend. So I'm just not a buyer of that because you have all this overhead supply. You're still in a bear market, and I like to play breakouts that go with the trend. So I'll play some bearish breakdowns, sure, but I have a hard time buying on a lot of strength and thinking that a strong day is a day to keep buying when you're swimming against the tide. That just doesn't set up favorably. But I could easily see this market start to roll over here. And we look back and we're like, yeah, stalled out right there at, 385 on SPY. That kind of failed right against that zone. By the way, if any of you follow the Bollinger Band concept that I teach, we are hitting the upper Bollinger Band. We don't have it on this chart, but we're hitting the upper band, which is 2 standard deviations above the average, and we're still below a declining 50-period moving average. What does that mean? Well, that's actually a bearish setup. That's a deep correction trading strategy. And again, the risk to reward towards being a little more bearish here. Now, don't get me wrong, I've been bullish. I've been thinking that this market would rally, but can it go a little further? Yes. Do I want to aggressively buy into it? No. Do I want to short it? Yes. Do I want to start immediately? Well, no, not in aggressive fashion. I'll kind of dip my toe in and keep building, but I do want to focus a little bit more on the bearish side of things here in the near term. So making a little bit of a mental shift for me, making a little bit of a portfolio shift, but I'm going to do it in kind of a slow manner. Something that stood out to me was the underperformance in energy. And when you start to see these changes that have taken place towards the end of a correction, what used to be strong oftentimes acts more weak, and what used to be weak acts the strongest. It's the dash for trash, as they call it, and so forth. But I would look at energy and say, man, it's been a heck of a year. It's been fantastic. I've been pounding the table. I love energy, love energy. Well, oddly enough, I'm not going to highlight any energy trades on the bullish side, and I actually have a bearish idea today. So I kind of like that as an area for potential weakness going forward. Insurance names, a lot of red there, so you could dig into that a little bit more. On the green, real estate, definitely the strongest. Now, rates and the US dollar rolled over today. That's important, and it's more bullish for bonds than it is for stocks. I think we could have a window here, and it is a little bullish for stocks, actually. It's part of why I'm not just ready to get aggressively short, because it is bullish. It's more bullish for the economy, for the markets, for other things. But it looks to me like rates have started to roll over. The US dollar has started to turn lower. Those are good things for some risk taking and at least a little window here where some of the things that have been really hammered can kind of come off. So I don't mind, looking in the real estate sector or looking in some of these areas for some buying, but that's something that I would kind of look at in terms of outlook. So we came into this week, as I said, Darren and I were doing the trading room and we were more here. I'm going to go to here on the rest of the week. I liked the market to do this ABC rally. I tried to emphasize that point in the weekend trading room that we should see a further bounce. We should see a little bit more rally to this. And then, well, that's where the rubber meets the road. So I think I'm cautiously moving towards this. But again, I think Thursday, I think the rest of this week will be kind of interesting to see how things progress. Now, let's look at a few different names. On the bullish side, Berkshire we talked about last week, and it was right here. And I kind of pointed this out earlier in this video where I said I don't like buying breakouts in downtrends, right? Because you got all this overhead supply. You're asking Michael Jordan to fly from the free throw line and dunk it, but you've got all this weight on top of his shoulders, and it's just impossible task. But we highlighted Berkshire last week and said on the pullback, we want to be buyers. Why? Because it should establish a higher low and should be a buying opportunity. Um, if you are a buyer there, I think it's the same mode. You're looking for the next pullback and then considering a new buy. So if you're already in, great on this pullback. If you're not, there's probably another opportunity coming. That type of name should outperform. I like thinking outside the box, and if you think about what is about as bearish a thing as you can possibly think of, it's an international, you know, European bank. That's about as bad as it gets. In fact, there were rumors that these were going to go bankrupt and so forth. So here's Deutsche Bank, and lo and behold, it's bottomed. It's actually gone back up, and it's at the same levels it was at in August and September. That's a lot better than most of the things you can find out there. In fact, Berkshire Hathaway, which we just talked about, is below those levels. Deutsche Bank is back to them. That's a little bit surprising, probably, to most people. I think it pulls back slightly and we buy the dip. So I'm in buy the dip mode. I'm not chasing this rally higher, but would I consider buying some things on a little pullback? Sure. And this is maybe at the top of my list. It's thinking outside the box because most people would be highly nervous to buy some European bank that's been rumored towards bankruptcy and so forth. I actually think it's kind of compelling. If you do the math on it, you kind of say, well, we've bottomed here. This was about 940 is the resistance level, and down here is about 720. So the size of the cup there is basically the difference between those, which is $2.20, right? And so 30% of that should be about the size of the handle. 30% of 220 is about 66 cents. So as you back off from 940, the general buy zone is at about 874-ish. And that's just an area. Somewhere around 875, that general area per share is kind of where I would be looking to be a buyer. If it gives me a setup around 875-ish per share, I'll be looking at it. We talked about Latin America. This is Mexico. It has broken out to the upside out of a symmetrical triangle. Again, I'm not really inclined to buy breakouts here so much, but we may get a little consolidation, a high base, and I think you want to continue to look at something like EWW, which is the Mexico ETF. They don't have the economic issues of Europe. They don't have a lot of the debt issues and things for other established countries, and just looks like a pocket of strength. On the bearish side, we continue to look at things like AMC, GME, the GameStop, the meme stocks. Nice rally today. This was kind of that dash for trash, right? The things that were the worst performers finally started to show a little life, and I think that's about all it has. My guess would be that it probably stalls here right around the 7 level and makes another leg lower. So you might already have a bearish position. We've been talking about these since back in here on this initial breakdown. So if you've been shorting since 10, it's been a fun ride, but I don't think it's done yet. Probably heading towards $5 per share, then $4 per share, and so forth. EQT, now this is in the energy patch and underperforming the sector. Looking at this chart, kind of a bounce back, but again, I think we're kind of in a little bit of this will just stall out here and then should have one more spike to the downside. So, but I just don't see a ton of upside. Even if you do the, kind of inverse cup and handle, or if you want to call this a descending triangle, you can do that. There, there might be a little, I mean, I could see another day of rally, sure, no problem, but it probably doesn't have much. I mean, this is kind of about how far it should rally up here to about 39.50 or so, and then start to turn back to the downside. So right under 40. My personal target is maybe at about 35 or so per share would be where I would kind of think that this thing is headed in the near term. And then last but not least, Procter & Gamble. Again, a lot of companies are reporting this week. I don't remember if Procter is, and I don't have a position in this by any means. I'm considering it, looking at it. I suspect this is weaker. It's broken the support back here. This might be kind of stalling out underneath it and get another leg to the downside. So Procter & Gamble and just the XLP, which is consumer staples sector, has lagged a lot of other sectors and looks like an area of weakness. So could be a name that I'll be considering. Markets are still in a bear market overall, but that ABC upside correction is playing out. We get advanced GDP coming out on Thursday. The expectation is for growth of 2.3%. And then Fed meeting is about a week away, not this week, but the following Wednesday. And the Fed is expected to raise rates by 75 basis points. So we've got a little bit of a quiet period here for a week or so with some earnings, not a ton on the economic report side as we get into next week in the Fed meeting. On the earnings side, we still have Apple and Amazon, like we talked about. We also have large cap energy. We've got Chevron and Exxon reporting. You've got Boeing and Honeywell in the industrial space. So a lot of different companies still to report throughout this week. Hope you enjoyed the market roundup. Have a great rest of your week, and we will see you next time. Goodbye, everyone.